Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, imagine a company with these stable billion-dollar revenues and a stock price that hasn't dipped at all in a year.
Right. Sounds like a dream.
Exactly. But behind closed doors, they are quietly entering a complete financial death spiral. I mean, we are sitting here in June of 2026, navigating the economy under President Trump, and this high interest rate environment has just, fundamentally shifted the ground beneath these major corporations.
It really has. The cost of borrowing money right now is, well, it's acting like this brutal, unforgiving stress test for every single business out there.
Yeah, and today, our mission for this deep dive is to show you why the traditional signs of a corporate collapse are actually a dangerous myth. Because according to recent analysis, most people think a company fails in this very visible three-step process.
Right, the classic three steps.
Yeah, like first their sales drop, then they panic and sell off some stuff, and finally their credit rating crashes and they go bankrupt.
Mm.
But waiting for those obvious steps is just a fantastic way to lose a lot of money as an everyday investor.
Oh, absolutely. I mean, relying on those highly visible steps means you will basically always be the last one out the door.
Right, holding a bag. By the end of this deep dive, you are going to be able to spot a sinking corporate ship way before the average stock market investor realizes what is happening. So, okay, let's unpack this.
Let's do it.
Starting with that supposed first step, which is the drop in sales. If you are only looking at a company's sales figures, their top-line revenue, you are going to be completely led astray.
Yeah, top-line revenue can be a total mirage right now.
Exactly. Let's think about this in terms of everyday personal finance for a second. It's like someone making a $150,000 a year salary. On paper, to their neighbors, they look rich.
Oh, sure. They've got the nice car, the big house.
Yeah, but if all that cash is immediately going toward massive credit card debt, incredibly high living costs, and like emergency expenses every single month, they are actually flat broke. They're living paycheck to paycheck on a six-figure salary.
That is a perfect analogy because large corporations do the exact same thing, just, with a lot more zeros attached to the balance sheet.
Right.
A massive company can hide their fundamental decline for a very long time by simply maintaining their revenue. They might aggressively hike prices on their existing customers, or they might be locked into massive multi-year contracts.
So that top-line sales number looks completely stable to the public.
Exactly. It might even look like it's growing slightly. But the real story is told when you look at their margins and their free cash flow.
Basically the money they actually get to keep after all the bills are paid.
Right, because if revenue is stable, but the cost to produce their goods is skyrocketing, their actual cash flow just starts to suffocate.
Wow, yeah. Or maybe they're having to offer these massive hidden discounts just to move their inventory, or suddenly their customers are taking 90 days to pay invoices instead of 30.
Which means they are burning cash just to keep the lights on. And data shows this isn't just an old-school manufacturing problem either.
Yeah?
No, a recent look at the private credit market from Morningstar DBRS, this is back in February of 2026, showed downgrades vastly outpacing upgrades by about 3.3 times.
Wait, really? 3.3 times?
Yeah, and a massive chunk of this pressure is landing heavily on traditional software and media companies.
Software. I mean, that's the industry we always thought of as basically printing money, right? Because the margins were historically so high, you write the code once and you sell it a million times.
Well, the landscape has fundamentally changed. Those historic margins are being violently disrupted by the transition to AI.
Oh, right. Because everyone is scrambling to catch up.
Exactly. These traditional software companies are finding themselves forced to spend absolute fortunes to integrate AI just to stay relevant. They are buying massive amounts of computing power, hiring incredibly expensive specialized talent, and, simultaneously losing their pricing power to new, leaner AI-driven competitors.
So their revenue might still look perfectly fine because of those older, locked-in enterprise contracts. But their free cash flow is turning heavily negative.
Precisely. The cost of running the business has skyrocketed, but the revenue just hasn't caught up.
Wow. So if they're burning through their cash just to stay afloat, that naturally forces a company's hand. I mean, they can't just print money, so they have to start selling things they own.
Right. Which brings us to stage 2.
Yeah, the second supposed warning sign, selling off assets. But wait, I want to challenge this for a second.
Okay, go ahead.
If a company is struggling, isn't streamlining and selling off extra business units actually like a smart, efficient move? I feel like Wall Street usually cheers when a company trims the fat and focuses on its core products.
Well, what's fascinating here is the massive difference between a strategic sale and a desperate defensive sale.
Okay, what's the difference?
A strategic sale is when a company sells a non-core asset, maybe a side project or a division that doesn't really fit their main vision anymore, and they sell it at a premium.
Right. They take that cash and invest it directly into growing their core profitable business.
Exactly. That is healthy capital efficiency. It shows management is focused on the future.
I see the distinction. So a defensive sale isn't trimming the fat at all. It's more like selling the engine of your car just to pay for today's gas.
That is exactly what it is. You are forced to sell your most profitable division, your golden goose, just to pay off debt that is maturing in less than a year.
Wow. So you aren't selling to grow, you are selling to survive Tuesday. You are literally giving up your future ability to make money just to pay today's rent.
Yes, and a textbook example of this played out recently with New Fortress Energy around June 18th of this year.
Oh, I saw that in the data. What happened there?
They had to get approval from the UK High Court for a massive restructuring plan. And a central pillar of that plan included spinning off their entire Brazil operations into a completely separate entity.
And I'm assuming they didn't sell off a massive functional operation in Brazil because they simply wanted to focus elsewhere. They must have been backed into a corner.
Absolutely backed into a corner. When you look at their debt profile, they had been slapped with a junk credit rating.
Oh, wow.
And with interest rates where they are now, having a junk rating makes borrowing money to fund something like massive liquefied natural gas contracts incredibly painfully expensive.
So the cost of fuel procurement in Latin America simply became too high for them to sustain with that poor credit profile.
Exactly. Securing long-term LNG contracts requires massive upfront capital. When your borrowing costs double or triple because of a junk rating, the math on those contracts just breaks down completely.
So spinning off the Brazil operations wasn't some brilliant strategic victory lap to unlock shareholder value.
No, not at all. It was a purely defensive move driven by intense creditor negotiations. They desperately needed to improve their balance sheet so they could literally just continue to operate their remaining business.
Man, so they've sold off the Brazil operations. They are scraping by. But the credit agencies are watching this desperate yard sale happen. And that brings down the hammer, which is the official downgrade.
Right, the dreaded downgrade.
But here's where it gets really interesting. I mean, regular investors usually wait for an official downgrade from agencies like Moody's or Fitch before they panic. But a downgrade is just a late report card.
Right. People think that, yeah.
If the company's been burning cash and selling off its best assets for a year, the fundamental damage is already done. The downgrade itself shouldn't logically change the value of the company overnight.
Well, the assumption that a downgrade is just a news report is a critical misconception.
Really? How so?
While it is a trailing indicator, telling you what's already gone wrong, it acts as a powerful mechanical trigger in the financial plumbing. It actively accelerates the crisis and makes the situation exponentially worse.
Oh, because of the strict rules governing institutional money, right?
Exactly.
I'm thinking about pension funds, life insurance companies, and massive mutual funds. When a company's debt falls from investment grade down to junk or speculative grade, they officially become what Wall Street calls a fallen angel.
A fallen angel, yes. And a lot of those massive institutional investors have legally binding mandates. They're simply not allowed to hold junk-rated debt in their portfolios.
So they are legally forced to sell those bonds immediately, regardless of the price.
Yes. This creates a massive coordinated dumping of the company's debt on the open market. And when everyone is selling and no one is buying, bond prices crash.
Right, and there's a strict inverse relationship between bond prices and yields. So when bond prices crash, the yield, which represents the cost of borrowing for that company, skyrockets.
You nailed it. Any new investor is going to demand that same high yield to lend them new money. Suddenly, a company that was already struggling to pay its existing bills finds that borrowing any new cash to bridge the gap just became prohibitively, punishingly expensive.
The research points to Warner Bros. Discovery as a massive example of this cycle, right?
Oh, absolutely. Back in June of 2025, Fitch downgraded them to junk status following a plan to spin off parts of the company.
And when you look at the mechanics of that spinoff, it left the remaining company smaller, much less diversified, and heavily exposed to the dying traditional cable TV industry.
Yeah, and cable TV is in a structural terminal decline. So you have a shrinking core business, and worse, they were drowning in roughly $37 billion of debt left over from their massive 2022 merger.
Ouch. 37 billion.
So the downgrade hits, institutional investors dump the bonds, their borrowing costs shoot up, and they just don't have the cash flow from that dying cable business to manage the massive debt pile. The downgrade didn't just report the news, it structurally made their reality significantly harder to survive.
That is brutal. Okay, so we've mapped out the cash flow mirage, the defensive asset sales, and the fallen angel downgrade trigger. But everything we've discussed so far involves public companies and public bonds.
Things anyone can look up, yeah.
Right, things anyone can look up on a financial website. But the data shows that in 2026, the real danger isn't happening in the public light at all. It's hiding in the private credit market.
The shadow banking system.
Exactly. Think of it like this. If public corporate bonds are like getting a mortgage from a major well-known bank where everyone can see your credit score and your public filings, private credit is completely different.
It's a whole different world.
It's like borrowing mass amounts of money off the books, where the loans are written in pencil rather than ink. You go to a private lender, negotiate a custom deal behind closed doors. The terms are private, the interest is private. If you default, the public stock market might not know until the walls are literally caving in.
Right. And over the last decade, as traditional banks pulled back from lending due to strict regulations, private credit stepped in to fill the void and just exploded into a multi-trillion-dollar industry.
Multi-trillion.
Yes. But because it's private, it is highly illiquid. There is no daily ticker tape showing what these loans are worth. The true value of these assets is incredibly murky, and that opacity is hiding an enormous amount of risk.
And the data shows this shadow market is suddenly hitting a massive wall.
Right.
I mean, just a few weeks ago, analysis revealed that U.S. private loan issuance absolutely fell off a cliff.
It plummeted.
Yeah, plummeting 40% in just 3 months, down to about $44.7 billion. That is a massive, sudden freeze in lending.
It tells you that the private lenders themselves are getting incredibly nervous. They are hoarding cash and pulling back from the market.
Wow.
But the real issue is how these existing loans are being valued. Look at the recent move by the Australian Securities and Investments Commission, or ASIC. They officially demanded that the massive $200 billion Australian private credit industry realistically revalue their assets.
Which brings us back to that idea of loans written in pencil. In a public market, a stock price changes every second based on thousands of trades. It's called marking to market.
Right.
But in a private market, these loans don't trade. So the fund managers get to use what are called book values. They essentially get to run a mathematical model and estimate what the loans are worth based on their own internal assumptions.
Which is terrifying, honestly.
Yeah. And ASIC feared these managers were keeping the values artificially high, completely ignoring the reality of the global economic shocks and the high interest rates that are squeezing the underlying companies.
Well, when an asset is illiquid, human psychology just takes over. Fund managers don't want to admit their investments are losing value, so they delay marking down the price. They just assume the underlying company will eventually bounce back.
But high interest rates physically impact the ability of those underlying companies to service that hidden debt.
Exactly. The book value becomes a total fiction, just a number on a spreadsheet that ignores the physical reality of the market. It gives the investors in these funds a completely false sense of security. They look at their monthly statements and think their investment is perfectly stable.
Meanwhile, the companies they lent money to are quietly bleeding to death. And this creates a terrifying contagion effect. It's not just the underlying companies going broke, the massive funds lending them the money are starting to freeze up too.
We saw this with heavy hitters like Blue Owl Capital earlier this year.
Oh yeah, in February, right?
Yes, they had to sell off $1.4 billion in assets across 3 of their credit funds and fundamentally alter their redemption structures because the pressure was mounting, especially in their software sector loans. Investors were getting spooked and asking for their cash.
And Ares followed a similar path shortly after in March. They had to cap redemptions at 5% on a massive $22.7 billion fund.
Which is a massive red flag.
Just to explain the mechanics of that to you, capping redemptions means investors knocked on the door and said, I want my money back. And the fund manager replied, sorry, you can only have 5% of it.
Yeah, it's the financial equivalent of a bank locking its doors because of a bank run.
Exactly.
Yeah.
Too many investors wanted their cash back, and the fund couldn't sell its private illiquid loans fast enough to pay them. So a company's publicly traded stock might look fine, But if the private funds lending the money are locking their doors, a massive liquidity crisis is brewing right under the surface.
It's all connected.
So what does this all mean for you? How do you actually spot this? If the steps don't always happen in a neat, predictable order. Because the sequence we just talked about can and will break.
Oh, absolutely.
Sometimes a collapse doesn't start with a slow, agonizing decline in cash flow. Sometimes it starts with a total overnight collapse of trust. Look at the First Brands case from just a few weeks ago in June.
Right. The collapse of First Brands didn't start on an income statement. It started when the founders and executives were indicted for a $3 billion loan fraud.
$3 billion.
Yeah. The allegations involved completely fake invoices, double-pledged collateral, and putting up assets for loans that simply did not exist.
That is insane. You could be analyzing their sales numbers and margins all day long, thinking the company is fundamentally sound, while the entire foundation was completely fabricated.
The trust just evaporated in an instant.
And the company suddenly needed emergency bridge financing from General Motors and Ford just to survive the week.
Huh.
It proves that you can't just trust the top-line numbers, and you can't assume a slow, orderly decline. You need a practical toolkit.
You really do.
So let's lay out a rapid-fire checklist for the beginner investor based on the realities of the market right now. Rule number 1. Do not just look at stock prices.
No, definitely not. The stock market is famously, relentlessly optimistic. A company's stock price can hold up reasonably well while its underlying bonds are literally crashing. The bond market is driven by institutional math, not retail sentiment. Bondholders don't get a share of the profits if a company does well, they just get their fixed interest. So their entire worldview is focused exclusively on risk and downside. If the bonds are tanking, the stock will eventually follow.
Rule number 2. Look at EBITDA margins instead of total sales. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
Think of it as a much closer proxy for the actual cash profit a company makes from its core operations before the accountants get involved. If sales are flat but EBITDA margins are shrinking, the company is bleeding cash internally.
Exactly. And rule number 3 is arguably the most critical factor in a high-interest environment. Look closely at their debt maturing in the next 12 months.
Refinancing risk.
Yes. The crucial question isn't just whether they have debt, but whether they can refinance it. S&P Global recently projected default rates for speculative-grade companies to hit 4.0% in the U.S. and a 3.75% in Europe over the next year.
Which is huge. When money isn't virtually free anymore, the game completely changes. Having a good functional product isn't enough to save you.
No, it's not.
If a company has a mountain of debt coming due, and current interest rates under this administration are double what they were when they originally took out that loan, their ability to simply refinance that debt is the literal difference between life and death.
Right. If they can't afford the new, higher interest payments, they hit the wall. It doesn't matter how cool their software is or how many customers they have.
Exactly. So to summarize what we've unpacked today, a corporate collapse is rarely a sudden, unpredictable explosion. It is usually a slow suffocation.
A very slow suffocation.
It starts with the invisible suffocation of cash flow, even if headline revenue looks fantastic. Then it leads to desperate defensive asset sales where a company is forced to sell the engine of its car just to buy today's gas. And finally, it triggers a credit death spiral, where downgrades legally force institutional dumping and borrowing costs skyrocket. And the most terrifying parts of this process are currently hiding in the murky, illiquid private credit markets, completely out of sight from the daily stock ticker.
I want to leave you with a final thought to ponder, something that really connects everything we've discussed today.
Okay, let's hear it.
We've seen that major alternative asset managers are capping redemptions on multi-billion-dollar private credit funds. They are locking the doors. If the smartest, most connected institutional money in the room is currently being blocked from withdrawing their cash from these massive shadow funds, well, what does that tell you about the true safety of the public stocks you might be holding right now?
Wow. A sobering thought to take with you into the markets this week. Don't forget to subscribe and hit that like button.